Hello, everyone. This is Jason Hsu. First of all, thank you for joining us on such a short notice. Now, you've noticed I'm still wearing my Japanese anime t-shirt. Anyone who's interacted with me recently on social media knows that Rayliant and Sumitomo Mitsui has recently launched a Japanese ETF together, and this is why I have a anime t-shirt on almost constantly to remind everyone of this product offering. We're obviously very excited about Japan as an asset class. And today, my very, very good friend, Mr. David Young, has agreed to host a webinar where he runs a thriving OCIO business and really very much represent the independent advisor channel. And then he'll be asking us questions about why should he allocate advisor portfolios into Japan? What are the risks? What are the possibilities? And specifically, how is our active ETF perhaps a more interesting option in that space? But before we get started, let me introduce Alex Hart, who is dialing in from Tokyo, representing Sumitomo. And I know this is very, very late for you, so we want to make great use of your time and your willingness to sign up to the webinar right now. And of course, Dr. Phil Wool and myself are co-PMs on the Active Japan ETF, and we'll be here answering questions from David. Now, with that introduction, David, over to you.
Great. Thank you, Jason. I appreciate that. We're going to start with a bit of housekeeping. Investing involves risk, including possible loss of principal. International investing, including investments in a single country, may carry heightened risks. Investors should carefully read the fund prospectus and consider information on the investment objectives, risks, charges, and expenses of the fund. The prospectus and other information is available at funds.rayliant.com. Well, we are now officially disclosed and disclaimed. With that having been said, let's go ahead and start our panel. Let's get going. I think a little bit of stage setting might be helpful. Some general discussion and comments about the Japanese equity market. Some of you are experts, some of you not, and we want to make sure we're catering to the broad audience. So let's kick it off with Jason. Jason, how has the Japanese stock market performed in recent months, and what do you think are the factors driving that performance?
All right, David. So when you talk about Japanese equity market performance, you always have to think about, is it with the currency movement or without the currency movement? And we know the last 2+ years, the Japanese equity market adjusted, for the FX, right? It's one of the best performing asset classes, but if you take into account the yen depreciation, it's roughly flat. And so that's been about the same story, I would say, the last 6 months as well. And when you think about that, what that's telling us is, for those of you who are concerned that the Japanese market, because of the recent strong movement, has become expensive, well, really, you adjust for the fact that yen's become very, very cheap. Really, you're really just at the front of perhaps a structural bull market as an international investor, meaning you haven't really lost out on the opportunity to get in, because where the price has gone up, the depreciation of currency means you could actually go in and buy these assets at about the same price as they were priced at internationally 3 years ago. So I think that's sort of my bid to investors who are looking primarily at the local price return, who's thinking the market's gotten too expensive. When in fact, I think for international investor, this is from the currency effect, this is probably as good of a entry point as any.
We've all seen occasional, let's face it, Japan and the economy as well as the stock market has given us all a few head fakes over the last, many, many years. So that's going to be, I think, of keen interest. So Alex, maybe you can elaborate on that a little bit. What do you see as driving the resurgence? What are the main factors behind the economic and stock market performance? Maybe a little bit too on that structural bull market concept.
Japan is a rather interesting economy, as I'm sure everybody's aware. It's actually the only economy that's experienced very long-term deflation. And of course, deflation, when you think about corporate earnings, they are nominal. So nominal GDP did not grow in Japan. Corporate earnings did grow. In fact, actually, over the past 10 years, the EPS growth in the Japanese market has been on par with the S&P 500, the US market. So around 10% CAGR, but that's all come from cost cutting. It's come from depreciation, so smaller investments. And I think what we're seeing in Japan now is That's beginning to change. So Japan faced the same global inflationary pressures as the rest of the world. In some ways worse, because we had the weak currency. But actually what we've seen as a result of that is the supply side shock, the initial shock in import prices, we're beginning to see filter through to wage growth. The wage growth this year is above 5% in nominal terms. Last year was 4%. Again, by international standards, it doesn't sound like a lot, but we're talking about highs since the bubble era. And so we're beginning to see a positive cycle of wages and prices. And again, wage price cycle, it doesn't sound good from, I would say, traditional economic thinking, but to break out of Japan's deflationary spiral, it's exactly what the doctor ordered. So I think that I totally agree with what Jason said. We're very much at the beginning of a secular bull market that's likely to be driven by, I would say, radically different assumptions in terms of the nominal GDP growth within Japan. So we expect core inflation to remain around 2% going forward, and that alone could result in EPS, high single-digit EPS. Then you have all of the scope for capital efficiency improvement, corporate governance improvement. Many of my peers in the industry are talking about the Tokyo Stock Exchange initiative. I think that's more of an auxiliary thing. But I'll leave it there for now and pass back to you, David.
So I saved the hard question for Phil, which is that one about what's the evidence, what's the case that this time it's different.
Yeah, I mean, as investors, we're taught to be wary of the "this time is different" type thinking. But from a macro perspective, I think one of the contributors to the false starts that Japan has seen is psychology. Deflationary expectations have become really deeply ingrained in consumers, and so people have this mindset. They just want to save. They don't want to consume. Companies can't predict demand, and so they're not investing. And that's really a vicious cycle. So one of the necessary conditions for a change is that consumers have to break out of that mindset. And I think with the inflation of the pandemic shock that Alex mentioned, with wages rising now, and you're seeing that wage price spiral, that is exactly what you need to just shock consumers out of that deflationary thinking, and they start to expect inflation. And we're seeing that come through in consumer surveys, for example. So I think that's the first piece. And then Alex touched on some of these corporate reforms. I think that's another aspect that's been lacking in the past. This is one of the perceptions that foreign investors have of Japanese companies, is that they're not quite as efficient with their use of capital. They're not returning capital to shareholders. But these are exactly the sorts of things that reforms are addressing. And that's been really effective, so much so that you've got countries like China and even South Korea now trying to replicate the success that Japan has had implementing these reforms. So I think those are ingredients for an economic recovery, and it seems more sustainable this time than some past episodes.
So I'd be curious to hear thoughts on Japan vis-a-vis global economic trends, particularly in the US and China, and how those very large economies and very important trading partners might be affecting Japan.
Japan is very, very much, a critical player in the U.S.-China tension geopolitics discussion, right? A lot of what we're seeing in terms of friendshoring, which is U.S. asking for more of the global manufacturing to move away from China and toward other economies that are sort of friendly shores to the U.S. There's no friendlier shore in the Pacific theater than Japan for the U.S. And I think a lot of Chinese companies are very aware of that. And you put that on the backdrop of the very cheap yen. What we're seeing right now is a record number of foreign direct investments coming from mainland China into Japan. And what that's signaling really is relocation of manufacturing capacity. So a lot of factory operators in China are now acquiring factories in Japan, hoping to at least manufacture maybe the last 15% of products in Japan. And what that means is, like, China exports about 3.3 trillion a year, right? And that's about 5 times as much as what Japan exports. And so when you have a 5% move out of China into Japan, that's a 25% increase in export, right? So we're seeing a lot of value being shifted from mainland China to Japan as a result of U.S. friendshoring initiatives and U.S. sanction, and that's going to be a huge boom for Japan first and foremost. And another part, right, because U.S. does need Japan to be its sort of unwavering ally in the Pacific theater with regard to kind of U.S.-China strategy. What that means is Japan is going to be able to extract better terms when it comes to, I would say, trade clauses with the U.S., expanding trade relationship with the U.S., and that again can only be a tailwind to Japan.
Let's talk a little bit about passive versus active. Is passive the best approach? Jason, maybe if you want to continue on with that thought.
So when we first made our asset allocation call and say, we ourselves want to invest in Japan, and advisors that we service should look at this asset class, right? Our next move was to think about, do we create a active or passive product? And also, what type of sort of style do we want to bring to market? Now, we landed on active and something that's sort of growth and mid cap, really, in the final product design. And the reason for that is, look, there are great passive large cap Japanese products out there already, and basically you can buy something that tracks the topics or the Nikkei easily, and those are cheap and liquid, and so we don't need to reinvent the wheel. We should tell advisors that it's a great opportunity and have them invest in those products. So how can we add value? We can add value by bringing something that will be a good complement. And when you think about Japan, no one thinks of Japan as growth oriented, right? People have historically thought of Japan as large cap value if you're going to earn any kind of return at all. And so I think we're at the part of the cyclical cycle where the cyclical bull market suggests anything that's higher beta, anything that's growth oriented, is more likely to benefit from this cycle. And also, I would argue, with all the initiatives that's happening in Japan right now, it is going to be a larger tailwind for growth oriented, slightly more mid in nature companies. And so that's why we want to bring that product to market. And that product, naturally, because of the mid nature, because of the growth nature, an active approach makes more sense. Because that is just a noisier market with fewer coverage, far less efficient, especially these are also names that are not known internationally. And so that's the reason why we sort of brought the active RAYJ product we did. And I'll just sort of give you a funny anecdote, right? And one of my favorite stock within the portfolio is a name probably most people are not familiar with, but you are familiar with the product, which is Hello Kitty, right? And the company behind Hello Kitty is Sanrio, very much a SMID company that you would never have otherwise identified yourself, and you would not have access to that if you buy a large cap passive product. Hello Kitty has a global licensing revenue, annual revenue of about $4.6 billion. And that's right behind Disney, but yet trapped inside a mid cap company you've never heard of.
That's a lot of kitties. All right, maybe this is for Phil. You want to give us a sense of what types of companies in Japan are best positioned? Jason made a comment or two. We also talked about the growth SMID approach. You want to kind of flesh that out for us? Are there other facets of the market that you find interesting?
Yeah, I mean, Jason touched on some of the macro themes that I think drive the top-down sector allocation. One of those was friendshoring. Japan is known for precision manufacturing. There are plenty of companies in Japan that are part of the AI, the EV supply chains, and there are opportunities to buy mid-cap companies, as Jason said, that might be in a great position to benefit from that tailwind. Looking at consumer discretionary, particularly companies that have lots of foreign sales where the weak yen is helping them, but they have a premium brand, so they're able to pass through rising costs as inflation starts to set in. Those would be other good companies, sort of at the sector level. I want to talk a little bit more about that small cap focus that Jason mentioned. So the portfolio actually invests across market cap. So we've got, the biggest company in Japan is in the portfolio, Toyota Motors, but we also have much smaller companies. In fact, about 20 of the 30 stocks in the portfolio are below US $10 billion market cap. And there are a couple of reasons for that. One is that, as Jason suggested, if we think there's going to be a resurgence in growth in Japan, you want to buy smaller companies that are more levered to that cycle. So there's an opportunity there kind of tactically. Strategically, Jason also just briefly alluded to analyst coverage in Japan. Now, it's a really deep market. There are about 2,200 stocks in the topics universe. But once you go outside the mega cap companies, analyst coverage is shallow. And so with the local partner that we've got in Sumitomo Mitsui DS Asset Management and their analyst team, we've got a bit of an edge, I think, in terms of just deeper research on those smaller companies, and that creates an advantage in a market like Japan.
It does feel like it's been on a good run, the market as a whole. I know it's always dangerous to talk about an entire stock market. There's a lot more going on. Alex, you want to talk a little bit about maybe some of your sense of the valuation of the overall market, or maybe even some sectors of the market that might be overvalued, might be things to avoid?
Yeah, sure. So the overall market, the topics is towards the top of the 10-year range. If you look at the PE, so over 15 times. But then if you think about the nominal GDP growth prospects going forward, for example, if we had 1% higher core inflation in kind of the perpetual growth rate, I mean, you could potentially justify a much higher PE. So I don't think that the market is really overvalued. I would, draw a bit of attention to some areas where maybe expectations have run a little bit ahead of fundamentals. Some of the thematic and kind of more crowded trades. So I would say the yen carry trade basket, particularly low price to book basket. And this one I'd like to say a couple of more words about as well. So there's a preference in the market again, and I talked about the Tokyo Stock Exchange initiative, which is basically they saw that over half the companies are trading at below 1 times price to book, and so there was a lot of talk in the market about how 1 times price to book, that companies trading below liquidation value and so on, and you saw a lot of particularly I would say maybe retail traders in Japan buying into these names and some herding occurring actually, regardless of the quality. And some of these companies have cash, yes, but price to book, in itself is a really dubious metric because, the book value is not the market value. Typically, the assets are depreciating assets. I mean, and some of these companies, you see the ROE is much below the cost of capital. Yes, they have the opportunity to do share buybacks, but it's really a temporary solution. So what we are more interested in looking at is companies that can consistently improve their, I would say, core fundamentals. So their profitability, their operating income, but over a secular, trend with exposure to, I would say, growth themes in the market, and Phil mentioned some of those. So I would draw attention and maybe advise investors to stay away from looking at names that just appear cheap on basic, simple vanilla value metrics like that.
Well, we are here to talk about the new offering, Rayliant's approach, what the SMDAM Japan Equity ETF RAYJ is all about, how it's managed, maybe some of the features.
Yeah. So first and foremost, I mean, this is a partnership product. Rayliant is of course a quant firm. We specialize in multi-factor equity portfolios. We chosen to partner with Sumitomo Mitsui in this case because we want to have the best of both worlds, right? Quantamental, I think, is in some ways it is the ideal product combination where you can bring kind of the unemotional, very disciplined, data-driven quant investing with the kind of depth and coverage that only active asset manager who's been in the market for decades can bring. And so the combination of the active stock picking, the active research, the on-site firm visit that Sumitomo can do, combined with our multi-factor approach, I think it's the ideal product for the market. And this is why we struck up this partnership to bring a Japan product to the market, particularly because we believe, a meaningful part of the portfolio has to be names that you otherwise wouldn't get easy access to by buying a passive product. And that makes the active component that much more important and valuable. And so that's really kind of at the core, the DNA and the genius of this product.
Yeah, I mean, I think this idea of having local expertise on the ground matters. Phil, do you want to elaborate a little bit on that? How it is you're going to work with Sumitomo Mitsui to find, we'll just call them the hidden gems, the local names, and we alluded to some of them before, that would be easily overlooked by someone on the other side of the planet trying to be active in what is really very large stock market.
So it's, I mentioned the number of holdings here. It's a 30 stock portfolio at this point. So it's a bit more concentrated, higher conviction play. I think quants are really good at evaluating a broad universe of stocks, and we can score every stock in Japan's market. But there's a lot of nuance that quant models can miss, particularly in a growth strategy, where a lot of what we want to try to capture is that future potential for growth that might not show up in historical data. And that's where, again, I would emphasize the importance of having boots on the ground. That's characteristic of the way that Rayliant approaches international markets. And it's especially important in Japan, as I mentioned, because of that shallow analyst coverage. Now, the team at Sumitomo Mitsui DS Asset Management, the analyst team that supports this strategy, they do about 2,000 company visits a year. So you can just imagine the kind of information that's uncovered in the course of that deeper dive research, and all of that goes into the strategy. So we think that having that local expertise is a super critical component to the strategy.
Maybe Alex, you can talk a little bit about it from a capitalization perspective, and then maybe we follow up just to tie it up. Phil, maybe if you could then follow on and talk a little bit about growth versus value attributes, again relative to topics, so people understand how RAYJ will behave relative to the index.
Phil said quite a lot to the idea of moving down the I would say the market cap spectrum in terms of size and the advantages that could bring to an investor. So maybe I'll give you a few examples from the portfolio that might kind of highlight how it differs from the topics. So I'll talk about our smallest cap company that we've got in the portfolio. And Jason talked about Sanrio, which is, few people probably know that, but I would almost willing to guarantee that no one will know this company. This company is called Sigmaxis, and the market cap is actually just over $400 million US. So in fact, it is more of a small or even microcap type name by international standards. So in the topics, the weighting of this name would be minuscule. So probably thousands or tens of thousands of a percent. It's a highly profitable management consulting firm operating primarily within Japan, and they're capitalizing on the trend that we kind of alluded to of productivity capex. So companies that are trying to modernize, trying to digitalize, providing services, particularly for digital transformation within Japan. And this company also reinvests some of the cash flow into a portfolio of companies that it invests in HR tech, health tech. So it plays into a number of, I would say, Japan-specific kind of revenue streams. So I would say pretty unique exposure that an investor can get access to through this portfolio. And I guess in that respect, that business line is kind of similar to venture capital. And again, venture capital is the industry here is really underdeveloped. So we believe that with the reallocation of capital going on over the next 5 to 10 years, it could potentially be a very exciting company. Even a multi-bagger, we could say, given the very small market cap at the moment. The ROE at the moment is in the high 20s in terms of percentage. So Topics itself is 8 to 9%. So you're getting double the ROE, and the price to earnings here is in the 20s. So it is slightly more expensive than the topics, but I think it's still great value for investors. And I would say even our top, the largest position in the portfolio, which is Fujikura. This is I would say more of a mid cap name actually, but in the topics it's still, the weighting is only 0.1%. And Fujikura really, falls under our generative AI, theme in terms of growth. So it's a medium to long term, secular theme that has exposure to. And this one as well, the forward ROE is 15%. So really, they provide they're growing sales of highly profitable optical components, which are used in servers, used in generative AI. And they also have, I think, potential to grow their earnings to beat their guidance essentially, as their more traditional business, providing optical equipment to telcos. So they have a contract with one of the major tier 1 US telcos. And this one again, the P is about 18 times, so it's really not much higher than the topics. So I think that growth at a reasonable price, or even at a steel quality growth aspect, is something that we look to achieve with the portfolio, and I think the size aspect helps us to do that, again because it is a relatively inefficient market.
Phil, I know you're also very close, of course, to every name in the portfolio. If you wanted to take up that value versus growth conversation, maybe some examples of some of the stocks you wanted to highlight. I know we talked about that in our prep session. And then also, if I could ask you, we do have a question about the currency hedging policy in the portfolio. If you would address that too, that would be great.
Yeah, so value versus growth. I think Alex did a great job of explaining why you don't want to be fixated on value in a market that's traditionally associated with value investments, that growth might be the way to play that. Alex also just touched on the notion of sort of top-down themes like generative AI. So portfolio construction is bottom-up in the sense that there's fundamental analysis going on, but there's also a top-down component in terms of identifying growth themes that are going to be a big tailwind for Japanese companies. A name that I like that's also in the AI theme is Marua. This is a company that makes ceramics, and in fact, it's a 200-year-old company. They started making ceramic tableware, but in the 1960s, they actually moved into electronic components. And now they make ceramic components for chips, basically heat dissipating substrates that chips sit on top of. And we know that as data centers are built out, they're consuming a lot of power. They're also throwing off a lot of heat. And so there's going to be demand for ways of addressing that. These are the types of companies you find in Japan. Not a lot of foreign interest in a company that's 3 billion USD market cap, but the analysts at SMDAM are locating these companies and helping us populate the growth portfolio that we've built in RAYJ. And then currency hedging. So, we talked at the top of the webinar about yen depreciation and just how weak the yen is. I mean, we're sitting at 3-decade lows in terms of the yen versus USD. That's been a headwind for investors overseas into Japan's market. At some point, we expect that turns into a tailwind. We're not currency hedged, and I think, as Jason suggested, that's one of the reasons that this is such a compelling entry point.
Very good. We are surprisingly on time. You guys are good. Any other comments about the market, this idea of a structural / secular bull market, some of the underpinnings, fundamental support? Is any additional comment I wanted to make? We do have a minute or two here to spend on that.
Yeah, so David, let me take those 3 minutes. First of all, I'm going to sort of advertise my LinkedIn article called "The Bridge," in which I wrote recently about why I believe there is a structural recovery for Japan that could lead to a secular bull market, not just a cyclical rebound. And then so let me summarize the key takeaway from that paper. Sort of key reasons, sort of key tailwinds. And one I talked about, which is, of course, the U.S. friendshoring. So I won't repeat that. but that's clearly one tailwind. Another one is we've been talking about Japanese household balance sheet repairment. We know, at the height of the real estate bubble, Japanese households went in very levered and lost a lot of money. Many of the households went negative when it comes to the equity value of their homes. They've spent the next 30 years repairing that, right? Instead of declaring bankruptcy and walking away from debt, they've been actually steadily making payments. So they finally paid down the massive mortgage that they owe on their home. And so now they own their home outright. And with the recovery in home prices, there's a meaningful balance sheet effect, first of all. And second of all, there's an income effect where previously that disposable income was not disposable because it has to go to service mortgage. Now it's fully disposable. And so you're seeing a meaningful increase in consumption as a result of that. So this balance sheet repairment for the household is very real. And this 30-year time period, right? It matches our notion of a 30-year mortgage and why 30-year was necessary for Japan to exit that that phase. So that's another major tailwind. Another thing is a meaningful improvement in corporate productivity. Now, part of it, Alex mentioned, is the topics, the stock exchange reform initiative requiring firms to improve their ROE, their PB, and I think that's had some effect. But like Alex said, that's really secondary. What you're seeing is a true improvement in productivity for Japanese firms, and you'd be surprised. The big catalyst was the COVID. Right, prior to COVID, Japan has fallen really far below kind of the global average, right? Japan ranked like number 87 in terms of business productivity technology adoption, right? We used to think of Japan as at the top of sort of business productivity technology innovation, right? They used to make all the high-end digital equipment for corporations, but they've since the bubble bursted, falling down to 87, right? We're talking about below countries like Thailand and Malaysia. Now, COVID has actually forced Japan to massively increase business productivity, so software and technology spending, because for the first time, people had to work from home, and Japanese companies have to figure out, okay, well, how do we measure productivity when people are working from home? So we moved from a basically seniority-based management system to much more meritocracy, much more management by KPI, laptop and sort of digital productivity tools and software became widely adopted only during the COVID time period for Japan. Post-COVID, Japan is like a brand new economy that's got all these fancy new toys that the other Asian economies have adopted already, except now this time, Japan is sort of leaping ahead of everyone because they're buying sort of the latest and newest incarnation of that. So a massive increase in productivity as a result of COVID, something doesn't get talked about as much. And of course, the cheap yen, which we have spoken to, right? Cheap yen is essentially a way of repricing Japanese labor costs to global buyers to make Japan now competitive. In some of the key areas, Japan is now cheaper than mainland China when it comes to a lot of software engineering and hardware engineering as well. And then that is making Japan, even though Japan is a very developed market, very competitive against some of the emerging market competitors. And that's another major tailwind.
That's helpful, and it does segue nicely into it's the question, right? What could derail growth? We've heard a good case. It's balanced. It's rational. We see the evidence, but if something were to go wrong, what are the most likely suspects, so to speak? And what if the headwinds are stronger than we think?
I'll take the obvious one and leave the harder, more nuanced ones to Alex and Phil. So the one thing that people have spoken about and why people want to be suspicious of this recovery is, look, how will the Japanese policymaker exit out of a basically 30-year period of quantitative easing, very cheap liquidity, ample liquidity, negative interest rates? Well, how does policymaker exit out of that as Japan, stock market and economy recover? And do they bungle that sort of policy unwinding in a way that may be detrimental? right? And so that is probably the biggest risk, right? Because right now, as inflation comes back, Japan is looking to begin increasing its nominal rate, which we know the positive benefit to that, right? Because Japan is a huge savers economy, right? When you have so many people who save so much money, when you increase interest rate, it means more disposable income, right? It means more interest income that they can spend, which is going to be a positive spiral as people spend more. It improves corporate profitability, increases wages, so on and so forth. But of course, on the flip side of that, as nominal interest rate is increased, it does increase cost of capital to businesses, cost of capital to anyone who has debt and servicing debt. And so to get that balance right, to get the speed just right, I think that's going to take some threading of the needle. So even though net this increase in interest rate will be a positive to disposable income, to household spending, to corporate income, but I think you don't want to shock the system prematurely or shock it in a way that creates sort of immediate short-term headwind.
Mm-hmm. Perhaps either Alex or Phil might want to comment on the what could go wrong question.
Yeah, I would like to add something to that. It's kind of along the same lines, I think, as what Jason was saying. But a lot of the problems that Japan faced with the deflationary era were caused by miscoordination between fiscal and monetary policy. And one of the things I'm concerned about is that this time the recovery is being driven by the private sector. So we're actually seeing, I would say more of a free market kind of solution, and inflation has been the driver here. But on the flip side of that, you also have metabolism that needs to happen within the Japanese economy. So we need to see the zombie companies fail, the low, the safe but low ROE projects that have, ruled I would say, the private sector for the past 30 years. These companies need to be allowed to fail. And I think that the dynamism there, that we are seeing evidence. Obviously, it's never good news to see the bankruptcy rate go up, but it has gone up actually significantly more than even during COVID. But there is a tendency here towards looking for top-down solutions. So I think the political aspect could be a risk. If you see if the administration sees a risk of I would say lack of support due to allowing these businesses to fail and not providing subsidies as has been done in the past. But I think it's necessary evil in a way, and I think I see some signs that Japan is in many ways ready to move on. But that would be one kind of risk factor that I think exists. Although for active investors, it's also creating kind of a bifurcation in the market. So winners and losers, companies are able to pass on costs, those that are not. And for us as active investors, I think it increases dispersion in performance, in revenues, and so on. So I think it could be very interesting from an investment perspective, but it is a risk to watch. I would say from the perspective of the economy, in my view.
Yeah, that's the exact point I wanted to make, which is Japan is in a really extreme situation right now. We talk a lot about 30-year highs and 30-year lows. And for the beta, it presents challenges because you expect that when you're trying to address issues that have been festering for decades, it's not going to be a smooth ride. But for active investors, as Alex said, those kinds of dislocations actually create opportunities. So there are risks, but there are also potential benefits to active investors who can be much more discretionary in terms of how they allocate.
Right. Interesting. Thank you. Good. No, that was very helpful. So we have a bit more time. We have another question. I'm going to read it. It's a little bit longer. How concerned are you about the scandal that the current administration is facing regarding tax dollars? Could it sidetrack momentum or reforms that are underway, or is it a non-issue? So that'll be a jump ball to any of our experts here today.
I would tend to say that it is a typically the opposition party in Japan is is not really been seen as a viable candidate for the administration. I still believe that policy-wise they are not, although we do have the approval rate has dropped significantly for the Kishida administration, and this recent scandal has been one of the factors behind this. This June though we do have a tax rebate that is going to, well, I think it's already been paid actually. So we do have that for consumers in Japan. I think it's about $1,000 or so to supplement the lack of real wage growth that we've had. So I believe that some of that frustration at the administration is due to issues that are not necessarily within their control, so the inflationary environment. And I think that as consumers see notable improvement in their so-called bottom lines, in their take-home pay, and real consumption recovers, I think that we should also see the approval rate recover. So and also in the Diet at the moment, they are passing new legislation about expenses. So I believe that similar problems will not occur going forward.
Well, under time, on budget, and with a lot of really interesting points having been made. So let's go ahead and look to wrap up then. Thank you to everyone who participated today. Phil, Alex, Jason. If you're interested in finding out more about the new RAYJ ETF, you can visit again funds.rayliant.com for more information. And I'll close by thanking everyone again for your time and attention here today. Have a great rest of the week.